Supermicro Computer, symbol SMCI on the NASDAQ, is a provider of application-optimized high-performance server and storage solutions. The company develops and builds server solutions at scale with its building block solutions system, I should say. The company is trading at $1,085 per share at this time, and it has a market cap of $61 billion. There's quite a bit of volatility in stock, so if you're looking at this tomorrow and that price is off by $100, blame the volatility, not me, because the stock is trading up 283% year to date, and that's 965% over the past year. Massive gains over the past year if you're holding it over the past year. But diving into the last quarter, fiscal Q2 2024, which is just year-end 2023, net sales increased 103% to $3.66 billion from $1.8 billion. Gross profit increased to $564 million from $337 million, a 67% increase. Gross margins, however, fell to 15.4% from 18.7%. So the company is not seeing that gross margin uplift like a semiconductor manufacturer like NVIDIA is doing. Unlike NVIDIA or really any other company that has seen this massive uptick in sales, plus the increased margins, it's really a multiplicative effect. You're seeing the opposite with Supermicro Computer. You're seeing the bottom line shrink in regard to sales when you're looking at compared to like the sales growth, I should say. So it's not as big of an increase when you're looking at a decreasing margin compared to an increasing margin because it is that multiplicative effect. The company attributes the decrease in gross margin to product and customer mix, partially offset by lower cost of goods sold and manufacturing efficiency. In the conference call, the company elaborates on this, saying it was really to win over new customers and remain competitive. In other words, they need to compete on price to acquire additional sales. So they're taking a lower margin to get that sales number up, which is why you're seeing higher sales, lower margin. Well, part of the reason they likely would have had higher sales regardless, I should say. Supermicro really needs to compete on price, though, as the product being really server racks and server systems is not really a product unique to them. There are many other manufacturers that are combining the subsystems, your CPU, your GPU, your storage systems to create server racks and servers. It's not unique to them. That's why you get these lower margins compared to the NVIDIAs or the Intels or the AMDs of the world. It's not them actually manufacturing the individual components. But continuing to move down the income statement, the company has increased its operating costs, SG&A, R&D by 58% to $193 million. As sales and gross profit increased at a high rate, this implies some sort of economies of scale at least. The result is operating income of $371 million from $250 million, a 73% increase. Moving down to net income now, it increased by 68% to $296 million from $176 million. Net margin came in at 8.1% compared to 9.8%. So the economies of scale is less impactful than that decrease in gross margin when you're looking at the sales relative basis. On a diluted per share, the company's EPS was $5.10 compared to $3.14. Then on a non-GAAP EPS basis, it was $5.59 compared to $3.43, with the only significant adjustment in their non-GAAP being really share compensation. They had some litigation stuff in the prior year, but really it's just share compensation for the adjustment. Shifting to the balance sheet, it's strong, net cash position of $350 million, so no concerns there. For fiscal Q3 2024, the company is guiding to sales of $3.7 billion to $4.1 billion and a GAAP EPS of $4.79 to $5.64, a midpoint of $5.22, which would imply sequential, so quarter-over-quarter improvement of about 2.3%. So still growth, but you're not seeing that massive uptick of growth like you did over the last quarter. For the fiscal year, the company has upped its previous guidance, however. It was previously $10 billion to $11 billion. And now it is $14.3 billion to $14.7 billion, a 38% increase from the midpoints. I will say, however, they did completely exceed their previous guidance, whether they not do that again. But you're seeing that across really the entire industry. You're seeing pretty much anything to do with semiconductors beat their guidance. I think they're really sandbagging their guidance in many cases just so they can beat it. Or it's them not expecting it, which is management not having the foresight to see what the actual growth is to be. So that's actually can be a bit of negative because they're not seeing the foresight. So once it falls off, their guidance may be way overshooting it as well. Moving to valuation, SMCI trades at a whopping trailing P of 85 times, a price to sale of 6.6 times. These are not cheap. We can look at the historical average P, which is about 19.5 times, and that's even accounting for the recent couple quarters of high price to earnings, which does push up a few points. Like if you're looking in reality, it's probably closer to 15 prior to this. You can see as well on that graph that it was actually a period which it was trading quite a bit below that average. And that's really when you saw the earnings uptick before the massive price increase. And that's when you would have actually wanted to buy. But that's different now. Because even on a forward basis for the yearly guidance, the price to sales is still 4.2 times. If you take the PE and the net income margin at 9%, which was actually above the last quarter, so being optimistic here, that's still PE of 47 times. That's still very high. You need a couple more years of these super high growth rates to support the current valuation, the current 1085 share price, 1100-ish dollar share price going forward. You need that high growth to even support the current share price, let alone any more further appreciation. So, concluding, Supermicro's computer share price has just surfed the AI wave, but the company's performance, all by benefiting from AI, does not support this degree of increase. When you're seeing a tenfold in price year over year, you need to see massive, massive numbers of systematic change to the company's operations. You're not really seeing that here. You're seeing them still build the same products that they were really 5 years ago. Of course, new technology, don't get me wrong, but it's still the same server racks. You're not really changing much when AI, instead of a GPU, you're putting an AI accelerator, which most of them still call it GPU anyways, your NVIDIA H100 cards, whatever you want to call them, some sort of AI accelerator, but their product is really the same. They have not really changed anything, which is why you're not seeing this margin increase like you are in other sectors, in the other semiconductor space. So, and as well, they're to increase their sales, they're actually seeing a decrease in gross margin, meaning you're unlikely to really see that huge expansion in net income margin like you have in other companies as well, which really limits the growth of earnings. Yes, the share price should have increased year over year, but it is way too much at this time. You're way ahead of yourself. You're really priced to, I would even say, over perfection at this point, which is the concern. Yes, the company's operations may do good, but they're pricing in so much growth at the current price that is just too high at this time.
Yeah. Tremendous growth probably this year and into next year. Hardware, any type of hardware business priced at those valuations historically scares me because you just, in hardware, there's booms and busts, and also it is a race to commoditize any type of hardware over time. So, they just don't get the multiples that like a software company could consistently get over time. Aaron, any thoughts, Brennan?
No, it's an expensive valuation, right? I mean, if you're willing to pay, 85 times or even 47 times forward, it's there's other companies, higher margin business, more recurring revenue style businesses that you can buy if you're willing to pay those valuations. So for me, I mean, obviously there's a lot baked into that, a lot of expectation baked into that. It's so far above where, the valuation has been in the past. Of course, we always have to consider, a lot of times companies change, the outlooks, the markets completely change, and it justifies a higher valuation. But it's too expensive.